In the last video, I gave you kind of an overview of sales, and I showed you specifically how sales shows up on the income statement. In this video, I'm going to begin working a problem that actually uses it. So here I've got my problem, and what it says to do, first we'll read the directions. I'm supposed to journalize, record, and post transactions. Well, if you've done the videos so far, and if you know what's going on here, you know what journalize means. It means record things in the general journal. And you should know what posting means as well. It means taking things from the general journal and posting it to the general ledger. However, in this video series, you're going to learn about what it means to record these and what that means in these directions. And also, I'll show you how to prepare a schedule of accounts receivable. All that's coming up. So here we go. First, I need to set up my company. He runs a company selling Elvis merchandise. Our great business owner, Jim. Elvis merchandise. This is going to be General Journal, page 1. So, here we are, and I've given the sales tax for you here. June 1, this is 2014, and June 1. He sells $450 worth of merchandise for cash plus 5% sales tax, and this one is given. I could do this on a calculator as well if I wanted to. It's $450. All I do is I multiply it times 0.05. Notice I've converted the percent to the decimal there. Is 2250. That's how I get that. So what this means in my transactions, first of all, this person has paid me. There's no accounts receivable in this one. This is all cash. So my cash has gone up. And they've paid me not only the price of the merchandise, but also the sales tax. So I can add those two things together. $472.50. And my wonderful software is rounding it for me when I don't want it to. So let's see if I can get it not to do that there. And then I now owe the government. I have sales tax payable. Sales tax payable. $22.50 of that amount was not really money that I can count as sales. That's money that I'm going to have to pass that along to the government when the government comes around to get that, and that's a credit because payables, this is a liability. I now owe this money to the government, so it's payable, which is a credit balance. And I've also got sales. Now sales, let me show you on the income statement. Sales, this is a revenue account. It works just like fees earned did. It's a revenue account. I'm going to subtract some things from it later, but on the income statement, it's a revenue. So my revenue is $450. So there it is in T accounts. Now I can put this on the general journal. So cash is a debit of $472.50. I've got sales tax payable of $22.50, and then I've got sales of $450. So there's my first transaction here. And also, before I'm done, let me go ahead and indicate this will be transaction A. All three of these are transaction A. And you'll notice on the general journal, when we're entering things in the general journal, it's important to make sure that the debits for each transaction also match the credits for each transaction here. And in this case, that's true. $22.50 plus 50 equals 72. So we've got the same amount on both sides. I also need to enter a description here for what just happened. It'll be really simple here. I'll just say sold merchandise. Put in the sales tax. There's that. Sold merchandise, and I'll also indicate the cash transaction. They paid cash. And then that makes me done with this first line here. Now it's time for the June 3rd transaction. On June 3rd, our hero gym sells $340 worth of merchandise plus 5% sales tax. The merchandise was sold on account to Jackson Company with terms 210 in 30. Well, I'll talk about what those terms mean in a minute, but first let's do this transaction. We can do it in T accounts first. This one here, it's accounts receivable. It's on account and it's a sales transaction, so I didn't get cash for this one. He said, I'll pay you back later. So that means is I have to create another account on my T accounts. Accounts receivable. There it is, accounts receivable. And then the other two things are going to go to sales tax and sales, just like they did before. But this one doesn't give my sales tax, so I'll have to figure that out myself. It's going to be 340 times 5%. $17. That's how much sales tax is going to be owed. Transaction B. And then in addition to my sales tax payable, I also record my sales. And then I'll also have to record, and instead of cash this time, I'm recording accounts receivable, because this one is on account. And I'll have to figure out what that total is. That's going to be my sales plus my sales tax payable. It's $357 that Jackson Company now owes to me. So there's that. And now I need to put all that stuff over on the general journal. Find that. There's that. So I've got accounts receivable. And then and let me see here. That total was $357. Again, I've got sales tax payable, $17, and then I've got sales. Of $340. And then I'll need to also write a description here. Now these descriptions, I'll need to put in a couple of extra facts here. First of all, when I'm selling this merchandise on account, I'll put in the sales tax. There are two things that it's important for me to put on here. I need to put the usual things, but I also need to mention that who I sold this merchandise to, and also the terms. It's important for me to put these terms in this description. I need to mention Jackson Company, and I need to mention on account, and I need to mention the terms as well. This 210, and I actually put in a 0 there. Let me explain what these terms mean. This means that this is on account, first of all, and I want to give this company some incentive to pay me quickly, because while accounts receivable is an asset on the T accounts, I want to turn that into cash just as quickly as I can. So what I'm going to do is I'm going to give him a discount if he pays early. If he pays me $357 within 10 days, then that means I'll give him a 2% discount on the price. He doesn't have to pay me the full price. He gets a 2% discount. So he might like that. That'll give him an incentive to pay quickly. And the N30 means that the net is due in 30 days. Maybe he doesn't have the cash right now to pay me that $357 within 10 days, but he should pay me that full amount within 30 days. That is when it is considered due. So there is the June 3rd transaction. Let's do June 4th. And again, he's going to sell $250 worth of merchandise plus 5% sales tax. I'll do this one also on the T accounts like I have been doing, and then we'll transfer it over to the general journal. So I'm going to have to calculate this. 250 times 5% is $12.50. So that means sales is going to be $250. Sales tax payable is going to be $12.50. And then the cash, or let me see here, this is actually accounts receivable as well. On account to Holidays Incorporated, 210 net 30. So this is accounts receivable. And of course I'll add the sales tax plus the actual amount once my calculator comes up. There it is. So we've got 250, all right, 250 plus 1250. Those two amounts is 262.50. This down here, 262.50. That's transaction C. Transaction C. Transaction C. And I can go here and make this second row so that it gives all of the decimal points I want. So there's that. There it is. Pretty much just like the last one, in fact. This is on account. So here we go. Again, accounts receivable. The amount is $262.50. $262.50. Sales tax payable, and of course I'm putting there's the general journal formatting, debits first, credits second. Everything should add up. $262.50. Sales tax payable $12.50, and we'll do sales of $250. Then I'll do my description. See here. Here's where I'll have to go back and make sure that I write down the terms. All these, and it's the same terms as the previous one. This time it's not Jackson Company. So there's that third transaction here. And so I've done these first 3 transactions, journalizing them to the general journal. In the next video, I'll go ahead and finish up these last 3.